if a company is earning, say, 10% to 20% return on capital, it's creating value. Not a ton of value, but it's creating value. And if I see a company that's generating more than 20% return on capital, you should want that company to have all the capital that it can get and to reinvest that capital as high as possible, because it is creating a tremendous amount of value from the capital that's been given.
So we're having an intelligent conversation about cost of capital, which, as Charlie Munger said, is impossible. So this is kind of fun. What are your thoughts on like the discount rate versus WACC and some of those, I guess, concepts in relation to what we're talking about?
Yeah, there's lots of ways to do it. Again, if you ask the academics, they will tell you that weighted average cost of capital should be calculated out to like 2 decimal places, and it should be a function of the risk-free rate of return times the beta of the asset that's out there. I mean, if you want to do all that work, have at it. I personally believe that that's just extra work for not much gain in response. My personal rule of thumb is that I use a discount rate of a minimum of 10%, right? Because I can invest in just SPY or the S&P 500 and reasonably expect a 10% rate of return. So if I can do no work, buy the index, and earn a 10% return over the long term, that to me is my cost of capital that I should charge any other investment that I make. If a company is higher risk than the market in general, I want to charge even higher of a discount rate. So I know some investors that just apply a blanket 12% cost of capital across the board, and they make all decisions based on a 12% hurdle rate. So whatever you do doesn't really matter to me. I like to keep it simple and just say 10% cost of capital, and that's what I use as my discount rate.
And then how do you adjust for a riskier company, or maybe one that is even like lower risk, like, I don't know, throw out a name.
Microsoft.
Apple. Yeah, Microsoft. Perfect. So do you adjust that for a company like Microsoft versus maybe some small biotech microcap that you may be looking at? Would you adjust for that?
You certainly can. I personally don't, because if I'm going to be picking an individual stock, the first thing you need to know is, well, what do you want from that individual stock that you're not getting from the index in general, right? Mm-hmm. Most of the time, the answer to that question is a higher return. I'm picking this individual stock because I want to outperform what I could bet by just investing in the index in general. That is the usual answer. It's not the only answer. Another answer could be, I want lower volatility. I want a stock that won't go down as much as the index when a bear market comes, which is why people invest in consumer staples and utilities, and even a company like Berkshire Hathaway. Like Berkshire Hathaway itself is a very low volatility stock. So if the market goes down 20%, you can probably expect Berkshire to be down like 10%. So just wanting a smoother ride is a reason to invest in a company. Another one would just be income. You want a higher dividend yield or a higher shareholder yield than what the S&P 500 is providing. So assuming the thing that you're after from an individual investment is a higher than the higher rate of return, I see no reason to dip below a 10% required rate of return, even if the business is lower risk. Because if the reason I'm investing in the stock is to get a higher than market beating return, it doesn't make sense to me to lower my discount rate, even if the company that I'm studying is lower risk or lower volatility.
Yeah, I want to hammer this point home about the relationship between the return metrics and the cost of capital, because I think a lot of people, especially newer investors, focus only on the return metrics and don't think about the cost of capital. So can we kind of like, I guess, hammer that point home about how important that relationship is if you're going to invest in a company for more than 5 months?
Yeah, I mean, the discount rate, or the rate, this is the required rate of return that you have as an investor for buying an asset. So it is a critical input to the equation to know if a stock's current valuation will get you what you're after. This is why, so the discount rate relates very closely to the valuation you should be willing to pay. There's nothing wrong with quote unquote overpaying or paying a premium valuation for a company if in exchange you, the investor, are either willing to accept a lower rate of return or a lower risk profile, or even if you're paying a premium, you think that the expectations built into the stock are too low and the company will outperform even slightly elevated expectations. Ignoring the rate of return that you want as an investor is foolish, because you could potentially be buying something that, even according to your own model, has no upside, which is not, I would say, a good use of capital.
No. So what are some good returns, or what are some good numbers when you're looking at return on capital ratios? Like, what ranges would you suggest people kind of keep an eye out for?
So for me, I mean, there's lots of ways to judge this, and the returns on capital that you should expect from a company are very correlated to the industry that the business is in, right? Different industries have just different economic profiles. If you look at the tobacco industry or the pharmaceutical industry, those are industries that historically have had very high returns on capital. If you compare those to commodity industries or the energy industry, by contrast, the latter have much lower returns on capital. So the industry that you're looking in should have an impact on what you should deem as good or bad. However, with that caveat in mind, if a company is fully optimized for earnings, again, a huge caveat there, and it's earning a return on capital below 10%, I'm not interested. Like, no, thank you. That is a rate of return that is destroying value for investors. So I want at least a 10% return on capital before I would even consider it. I know you guys had Peter Compounding Quality on your show a week or two ago, and he said 15% is his minimum. But I think between 10 and 20% is a decent capital allocator, right? That should be something that's considered. And anything over 20% is truly a sign of likely a very excellent business. However, an important caveat with all return on investment calculators is that they are backward looking. They are what happened in the past. Was a company a good capital allocator in the past? And what really matters for investors is, what will the returns on capital be moving forward? So I think Oswald the Motorin warned about this, that if you just use return on invested capital to make decisions, your portfolio could be filled with zombie companies, right? Companies that are big established brands that were dominant decades ago, but their time has since faded. And if their returns on capital are poised to fall and stay low, you will not do well as an investor.
No, not at all. Something else you said I thought was really interesting and worth zooming in on. You said a company has to be optimized for profit. Can you explain what you're talking about there?
Yeah, this is when marrying investing with the concept of the business growth cycle is just so critical. So I believe that there are 6 distinct phases that publicly traded companies go through in their life. So early in their life, they're in the raise capital phase. This is when they are reliant on outside funding sources, such as selling equity to investors or borrowing from lenders. And these companies are intentionally spending more money than they're pulling in revenue in an effort to grow. After a company graduates through phases 1 and phase 2, when they're really growing and depending on outside capital, they reach the break-even phase, right? When they're not making money, but they're no longer losing money. And then after that, they focus on optimizing the business for profitability, really taking through and maximizing the margins of the business. Only when a company has fully maximized its margin potential is it truly earning the profits that the business is capable of generating. And that's when a company should have GAAP profitability and free cash flow production. And NOPAT should be a number that you can easily see and measure. So only when those profit metrics are fully shining through and the company is optimized for profits do any of the return on capital calculations even matter. Because prior to that, if a company isn't optimized for profitability, then all of the numbers in the numerators of those equations will dramatically understate the company's true profit generation potential. So they'll all be far lower than they would be otherwise. So yeah, it's critical that a company is fully optimized for profits, and in stage 5, which I call the capital return phase, that any of these numbers matter.
Would looking at a company like Uber be a good example of how a company kind of moves through that life cycle? Because for a long time, I don't think they were really optimized for profits, but it seems like they're moving more towards that. So would that be a good example of a company, if you looked at them 5 years ago and you looked at the return on capital metrics, they wouldn't really tell you much, but now they could.
Uber is a great example of a company that has gone through the business growth cycle. So when Travis Kalanick founded Uber, it was like 2012, 2013, somewhere around that. The company was completely dependent on investors, outside capital, in order to fund itself. In fact, it was subsidizing the cost of its rides. It was purposely underpricing them in order to grow and to reinvest in itself. And it was only really a year or two ago, it was not that long ago, that the company even started to generate profits in the first place. So looking at Uber on FinChat right now, I see that the company has a 32% gross margin, a 5% net margin, and a 12% free cash flow margin. Now, I haven't studied Uber in depth. I don't know if you guys have. Let's assume that 12% free cash flow margin is sustainable. Like, let's assume that is the actual free cash flow generation capability of the company. Well, the company's net margin is only 5%. So which of those numbers is accurate? Is 12% free cash flow margin accurate, or is 5% net income margin accurate? Again, I'm assuming the 12% free cash flow margin is accurate. So even when looking at Uber's return on capital numbers now, you might have to make adjustments to the numerator if the company's profitability is still underrated. So it might still be too early to look at the return on capital numbers for Uber to draw any conclusion.